This is another podcast from Alpha Business Media. Imagine this picture. A developing country, right? And it's sitting on enough foreign exchange reserves to cover its imports for, well, over a year. Sounds pretty secure, yeah.
It does sound incredibly secure on the surface.
That's the headline number for Nepal right now.
Right.
But, digging into the sources you shared with us, it reveals a much more, let's say, nuanced picture. It's not quite so straightforward.
Exactly. And what's really fascinating, I think, is getting into why those reserves are so high and then understanding this delicate balancing act the central bank's trying to pull off, that headline number. It's good, definitely, but it's kind of sitting on top of some pretty significant vulnerabilities underneath.
Absolutely. So welcome to another deep dive. This is where we take your sources, all the research, the articles, the notes you send us, and we really try to unpack the key insights for you. Today, we're looking closely at Nepal's economy, specifically the National Bank's latest monetary policy.
Right. We're going to explore how they're managing those big foreign exchange reserves, trying to influence imports, and also, this is crucial, trying to stimulate production at home. And everything we discuss, it's coming straight from the material you provided.
So let's set the scene quickly. Your sources paint this picture. Nepal's economy, heavily reliant on agriculture, yes, but maybe even more so on remittances, money sent home by workers overseas.
Hugely important, yes. Growth is, well, moderate, projected around 4.5% for this fiscal year, but there's definite inflation pressure. It was around 6% late last year, and a big persistent problem. A massive trade deficit. They import way more than they export.
And the National Bank of Nepal, the NRB, they're the ones steering the ship through all this, trying to keep things stable.
They are the key player for macroeconomic stability, absolutely.
And why should you care about all this? Well, think about those foreign exchange reserves, like a country's emergency fund. They buffer against shocks, pay for vital imports, fuel, medicine, machinery.
Things you absolutely need. And monetary policy, that's the central bank's toolkit, is how they try to manage inflation, control how much money is circulating, and basically guide lending and investment in the economy.
So our mission for this deep dive today, understand where Nepal's reserves actually stand based on your material. Then dissect the NRB's monetary policy for this fiscal year, FY 2024-25.
And really analyze that tricky balancing act they face, managing foreign currency, which often means thinking about import controls versus boosting domestic production. What are the real challenges and risks highlighted in the sources you shared? That's what we'll dig into.
Okay, let's start with the reserves themselves. Your sources show they've actually grown quite a bit recently.
They certainly have. The data shows that, as of mid-April 2025, gross foreign exchange reserves hit U.S. $17.63 billion, which is a pretty solid jump from about $15.3 billion back in mid-July 2024, the start of the fiscal year.
And most of that is held by the central bank.
Yeah, the NRB holds the lion's share, with the commercial banks holding the rest. Oh, and an interesting detail from your sources. About 20% of those reserves, as of mid-April, were actually held in Indian rupees.
Which really underlines the close ties with India, right?
Exactly. It reflects that deep trade relationship. And while the sources mentioned some, volatility earlier in the year, the overall trend for this fiscal year has definitely been upwards for reserves.
Okay, $17.6 billion. Sounds like a lot. But the real question is it enough? This is where it gets interesting for you, the listener, this idea of reserve adequacy. How long could that money actually pay the import bills?
That's the critical measure. And your sources provide the numbers. As of mid-April 2025, those reserves could cover 17.1 months of goods imports.
17 months.
Yeah. And if you include services imports too, it's still 14.2 months. Now, just think about that. 14.2 months. The standard recommendation for developing economies is usually, 3 to 6 months?
Right, that's the usual benchmark.
And the NRB's own target is 7 months. So Nepal is way above both of those. It indicates a very, very comfortable level of external liquidity right now.
That is a huge buffer. So where's it all coming from? What's driving these high reserve levels? Your sources point to a few key things.
Yes, but one factor really stands head and shoulders above the rest. Remittances. Money sent home by Nepalese workers abroad. It is the dominant source of foreign currency flowing in.
How big are we talking?
Well, the sources show remittance inflows grew by 10% year on year in the first 9 months of this fiscal year.
That's huge.
It's huge. It totaled NPR $1,191 billion. Just for context, back in 2022, remittances were enough to cover more than half of Nepal's entire trade gap. And they were worth about a quarter of the country's GDP.
A quarter of GDP, wow. And mainly from the Gulf and Malaysia?
Primarily, yes.
Yeah.
Those are the main sources mentioned.
Okay, so remittances are fundamental. What about trade itself? Is Nepal exporting enough to build reserves that way?
Ah, well, here's the flip side. This is the big challenge your sources highlight repeatedly. Nepal has a persistent, very large trade deficit. Imports just consistently swamp exports.
How big is the gap?
In the first 10 months of this fiscal year, the trade deficit was over NPR 1.25 trillion. Now, exports did grow significantly in that period. The sources mention a striking 72.7% growth.
That sounds impressive.
It does, but context is key. The volume of exports is still tiny compared to imports. The ratio is something like $1 exported for every $6.7 imported.
Okay, so the growth is on a very small base.
Exactly. And the sources also point out that a lot of that recent export growth isn't in high-value manufactured goods. It's often in things like, say, soybean oil that's actually processed from imported raw materials or other lower-value items. It highlights some deeper structural issues with Nepal's export competitiveness.
So hang on, if there's this massive trade deficit, how can Nepal still end up with an overall surplus in its balance of payments? And even the current account, your sources said, was in surplus.
Right. It seems counterintuitive, doesn't it? But that's the sheer power of those remittances coming in. Your sources show the overall balance of payment surplus was NPR 346 billion in the first 9 months, and the current account surplus was NPR 210 billion.
And that's almost entirely down to remittances plugging the trade gap.
Pretty much. The inflow from workers abroad was large enough to more than offset the outflow needed to pay for all those imports.
What about other flows, like foreign investment?
They contribute, but it's much smaller scale. Your sources note net capital inflows, and foreign direct investment, FDI, was around NPR 9 billion in those first 9 months. Peanuts compared to remittances.
Okay, so the story taking shape is high reserves, looking good on the surface, but driven overwhelmingly by remittances, which paper over this huge structural trade deficit. That sounds, well, it sounds a bit precarious, doesn't it? Is that a vulnerability?
It absolutely is. The material makes that very clear. This heavy dependence makes the whole economy quite sensitive to anything affecting those remittance flows. Global downturn, changes in policies in the host countries.
Like, the sources mentioned a dip earlier in the year linked to fewer workers going to Malaysia.
Exactly that kind of thing. It illustrates the sensitivity. If remittances were to slow down significantly and that big trade deficit stays wide open, well, those comfortable reserve levels could start to erode surprisingly quickly. That export growth is good news, don't get me wrong, but given the low base and the type of goods, it's not fundamentally fixing that trade imbalance yet.
Right. Which brings us squarely to the National Bank, the NRB. Let's unpack their monetary policy for this fiscal year, FY 2024-25. It came out last July. Your sources called it cautiously accommodative. What does that actually mean? What were they trying to do?
Cautiously accommodative.
Go.
Yeah, it suggests they were trying to gently loosen things up a bit, encourage some economic activity, perhaps after things felt a bit tight previously.
Yeah.
Their main goals, according to the sources, were pretty standard. Keep inflation stable, they were aiming for around 5%, ensure the balance of payments remain stable, and importantly, support the government's goal of 6% economic growth.
And they had a specific target for lending.
Yes, a key quantitative target was aiming for 12.5% growth in lending to the private sector, trying to get more credit flowing to businesses.
Okay, so how did they try to achieve that? What policy tools did they use?
Primarily interest rates. They tweaked their main policy rates downwards. The bank rate, which acts as the ceiling for their interest rate corridor, they cut that by 50 basis points. That's 0.5% down to 6.5%.
Okay.
And the repo rate, which is really their core policy signal rate, that also came down by 50 basis points to 5.0%. The floor of the corridor, the overnight deposit rate, they kept that steady at 3.0%.
So the basic idea is lower central bank rates mean cheaper borrowing costs throughout the system, hopefully encouraging businesses and people to borrow and spend more.
That's the aim, yes. Making credit more attractive.
Did they touch other things like the reserve ratios banks have to hold?
According to the sources, no. The cash reserve ratio, CRR, and the statutory liquidity ratio, SLR, those requirements for banks to hold certain reserves were left unchanged. It suggests the NRB was really focusing on using interest rates and their regular market operations to manage liquidity and steer those interbank rates towards their 5% target.
Okay, that was the plan back in July 2024. Did they stick with it? Did they make any changes midway through the year?
They did conduct a mid-year review, yes, back in February 2025. Your sources cover this. At that point, they decided to keep the main interest rates where there were no further cuts.
But they did make some other adjustments.
A couple of notable ones, yes. One was a change to loan loss provisions. They actually reduced the provisioning requirement for loans classified as good or standard, taking it down slightly from 1.7% to 1.0%.
Hmm. Reducing provisions when, as we'll discuss, non-performing loans were apparently rising seems a bit odd.
It does raise an eyebrow. The NRB's stated rationale, according to the sources, was to help banks manage the pressure from those rising bad loans, maybe free up a little capital, or boost reported profitability. But yeah, critics might argue it doesn't really tackle the root cause of the asset quality problem itself.
Interesting. What else changed?
Another thing mentioned was about car loans. They brought in a single uniform maximum loan-to-value, or LTV, ratio of 60% for all personal car loans. That included electric vehicles, EVs, which previously had a more generous limit, I think up to 80%.
So making everyone put down a bigger deposit, basically, 40% instead of potentially just 20% for an EV.
Exactly. And while the sources don't explicitly state the NRB's motive, you could speculate maybe it was aimed at dampening demand for cars generally, since they're a big import item, or perhaps it was about managing credit risk in that particular loan segment.
Okay, and they flagged a change for microfinance pricing too.
Yes, they announced that microfinance institutions would have to base their lending rates on a standard base rate starting from May or June 2025, aiming for fairer and more transparent pricing for borrowers in that sector.
Right, so these tweaks and the overall policy really highlight that core tension we talked about. The NRB has these comfortable reserves, mainly from remittances, but also this huge trade deficit. How do they possibly balance managing foreign exchange, maybe needing import controls, with trying to stimulate domestic production, which needs investment, credit, maybe even imported inputs?
It's the central banker's tightrope walk in an economy like Nepal's. And what's quite striking, perhaps counterintuitive again, is that the main policy for this year actually eased some import rules rather than tightening them, despite that big trade gap.
They ease them.
Yeah. They increased the financial limits for importing goods using methods like telegraphic transfer, TT, documents against payment, DAP, and documents against acceptance, DAA. Basically making it easier to pay for larger import shipments using these standard methods, and they even removed the TT limit completely for government imports.
Okay, hold on. Why on earth would they make it easier to import when the trade deficit is already so massive? Wouldn't the logic be to make it harder, save dollars, encourage buying local?
This is where the sources reveal a really critical constraint. It's about government finances. Your sources emphasize just how heavily the Nepalese government relies on the taxes collected on imports, customs duties. We're talking about roughly 40% of total government revenue coming from imports.
40%. Okay, wow. So if the NRB drastically restricts imports.
It directly blows a massive hole in the government's budget. Suddenly the government can't fund its spending.
Ah, I see. So easing import procedures wasn't just maybe about helping businesses get needed supplies, but also about ensuring that government revenue stream didn't dry up. That creates a real conflict, doesn't it? Fiscal needs versus maybe pure monetary policy goals.
Precisely. It's what some economists call fiscal dominance, where the government's borrowing or revenue needs heavily influence or constrain what the central bank can realistically do. The comfortable reserve level probably gave the NRB the breathing room to ease those procedures, balancing the need to support business activity with the absolute necessity of keeping government revenue flowing. It shows that complex interplay.
Okay, so that's the import side of the balancing act. What about the other side, actively promoting domestic production? What specific things is the NRB doing there, according to your sources?
They're definitely trying to channel credit towards what they see as productive sectors. The policy mentions plans to revise lending limits and rules on interest rates for micro, cottage, small, and medium enterprises, MCMEs. They're also expanding the list of sectors that can get loans on preferential or concessional terms, adding things like agribusiness support, farm tool manufacturing, IT, tourism.
So trying to direct the money flow?
Exactly. And there are specific schemes mentioned too, like preferential loans for young entrepreneurs, loans for returning migrant workers where their remittance history acts as a kind of collateral, special loans backed by agricultural produce stored in warehouses, and even education loans targeted at fields where Nepal needs more skilled people.
And support for specific struggling sectors.
Yes, the sources mention special measures for the construction sector, which has been facing difficulties. Things like allowing banks to restructure loans, extend repayment periods, and even a temporary pause on blacklisting firms that are struggling to pay.
That sounds like quite a comprehensive effort on paper, trying to push credit into these areas. But the big question is it actually working? Is this push to stimulate domestic production and lending having the desired effect?
Well, the picture the sources paint is pretty mixed, frankly. Despite the lower policy rates and all these targeted lending initiatives, the actual growth in private sector credit was only 8.3% year-on-year as of mid-April 2025.
8.3%, but their target was 12.5%, wasn't it?
Correct. So significantly below target.
Why the shortfall? If the central bank is trying to make money cheaper and available, why isn't it flowing faster into the private sector?
Your sources suggest a couple of major reasons. Firstly, the banks themselves are being quite cautious, and that ties back to the issue of rising non-performing loans, NPLs, bad debts. When NPLs go up, banks naturally become more risk-averse. They're less willing to lend, especially to potentially riskier businesses in productive sectors compared to, say, safer bets like trade finance or real estate.
And the other reason, is it lack of demand from businesses?
That seems to be part of it, too. Businesses might just not be feeling confident enough to borrow and invest, perhaps due to general economic uncertainty, maybe slower than hoped-for recovery, or maybe weak consumer demand affecting their sales. And then there's a deeper structural issue that the sources highlight again,
Which is
the structure of existing bank loans. Even now, a very large chunk, the sources say around 65%, is secured by land and buildings as collateral. This suggests that a lot of bank lending still gravitates towards real estate speculation or funding trade activities, rather than directly financing, say, new machinery for a factory or improvements on a farm. It's a long-standing pattern that's proven really hard to shift, regardless of monetary policy tweaks.
Okay, so beyond this immediate balancing act and the lending figures, your sources point to some pretty significant, deeper underlying challenges and risks for Nepal's economy. What are the really big ones?
Well, number one, which we've touched on, is definitely those rising non-performing loans. It's a major red flag. Both the NRB itself and the IMF, in the material you provided, flag this as a key vulnerability. That NPL ratio for commercial banks hitting 4.9% by mid-December 2024, that's quite alarming.
And the impact is?
High NPLs hit bank profits hard, they tie up bank capital that could otherwise be used for new lending, and they make banks much more reluctant to lend, period, especially to those productive sectors that might be perceived as higher risk. So it directly undermines the NRB's efforts to stimulate growth through credit. That tweak they made to provisioning for good loans, it might ease the financial reporting pressure on banks a bit, but it doesn't actually fix the bad loans already on the books.
Right. And you mentioned the Dutch disease earlier. Can you unpack that a bit more? How does that work in Nepal's context?
Yes, it's a really important concept here, linked directly to those huge remittance inflows. While remittances are absolutely vital, providing that foreign exchange cushion and boosting consumption, they can have this paradoxical negative side effect on the rest of the economy.
How so?
Well, the large inflow of foreign currency can push up the value of the local currency, making exports more expensive and imports cheaper. It can also pull resources, especially labor, away from sectors like agriculture and manufacturing toward services or construction, which might boom due to remittance-fueled spending, but aren't necessarily making the country more competitive internationally. Essentially, the booming remittance sector can inadvertently harm or crowd out other productive, tradable sectors.
So money flowing in actually makes it harder for local farmers or manufacturers to compete.
That's the core idea of Dutch disease. And your sources specifically mention research showing evidence of this in Nepal, a negative impact on primary agriculture and secondary industry sectors, while the tertiary services sector gets a boost. This makes the NRB's job of promoting domestic production even harder, because they're pushing against this underlying economic distortion caused by the remittances themselves.
So it really sounds like the sources are concluding that monetary policy alone just can't fix Nepal's deeper economic problems.
That's a very clear message coming through. The material emphasizes that tools like interest rates or credit targets have limited traction when you're up against fundamental structural constraints. And the list is long.
Like what?
Things like low agricultural productivity, often due to traditional farming methods, lack of irrigation, fragmented land holdings, a relatively underdeveloped industrial sector. Major infrastructure gaps, unreliable energy, poor transport networks making it costly to move goods. A challenging business environment, bureaucracy, red tape, sometimes political instability deterring investment, shortages of skilled workers, partly because so many migrate abroad for work, and sometimes government programs designed to help specific sectors just aren't as effective as intended. All these things act as brakes on production growth, almost regardless of what the central bank does with interest rates.
And we talked about the government's heavy reliance on import taxes. That fiscal dependence creates its own constraint, right?
It absolutely does. The sources clearly imply this fiscal dominance. The government needs that import revenue. This implicitly limits how far the NRB can go in restricting imports, even if, from a purely reserve management or industrial policy viewpoint, tighter controls might seem logical. Fiscal needs can, and likely do, sometimes constrain or even override purely monetary objectives.
Okay. So let's try and pull all these threads together. Based on everything in the sources you've shared, what are the main takeaways? What's the snapshot of Nepal's economy right now?
Well, the snapshot is one of, let's say, surface stability. You've got these comfortable foreign exchange reserves, which look great, but that stability is almost entirely thanks to those massive remittance inflows. Beneath the surface, the NRB is trying to stimulate a somewhat sluggish economy with an easing monetary policy.
But it's fragile stability.
Highly fragile. It's very vulnerable to any downturn in remittances because of that persistent large structural trade deficit. So the NRB is caught in this really difficult balancing act, trying to manage imports, which is complicated by the government's dependence on import taxes, while also trying to encourage domestic production. But that effort is seriously hampered by those deep structural economic problems that monetary policy just can't solve on its own.
And overlaid on all that are significant risks.
Yes. The rising tide of bad loans in the banking sector, NPLs, is a major worry, and the potential negative drag from the Dutch disease effects of remittances makes boosting domestic competitiveness even harder.
So looking ahead, what do the sources suggest needs to happen?
In the short term, they suggest reserves will probably stay adequate if remittances hold up. But for genuine long-term stability, Nepal absolutely needs to diversify how it earns foreign currency. That means a serious, sustained push for higher value exports, moving beyond just basic goods or re-exports, and attracting more sustainable foreign direct investment, particularly into productive sectors, not just real estate.
And tackling the underlying issues.
Yes, inflation could remain a sticky issue, but achieving strong, lasting growth really hinges on addressing those fundamental structural problems we discussed. Boosting agricultural productivity, fixing infrastructure, improving the investment climate, making government support more effective.
Does the material offer specific recommendations for the NRB or the government?
It does mention several. Things like strengthening financial sector supervision urgently needed given the NPL situation, perhaps using more targeted, smarter import controls instead of blunt instruments, developing actual strategies to mitigate those Dutch disease effects, making sure those targeted lending programs are actually effective and reaching the right businesses, improving transparency around monetary policy decisions, and strengthening the NRB's independence, which is a standard recommendation often echoed by institutions like the IMF.
And coordination is key.
Absolutely crucial. A major takeaway emphasized is that the NRB's monetary policy efforts, however well-intentioned, will have limited impact on fundamentally reshaping the economy unless they're tightly coordinated with government fiscal policy and, critically, with those broader structural reforms. It needs a whole-of-government approach.
It really highlights how interconnected everything is, which leads me to a final thought for you, our listener, drawing on everything we've unpacked from your sources today. Given these really deep structural challenges, Nepal faces the heavy reliance on imports and remittances, the government's dependence on import duties, the persistent problems in boosting domestic production. Can the NRB's monetary policy really be expected to drive a fundamental shift towards a more diversified, resilient Nepalese economy on its own?
Or is its role, perhaps inevitably for now, more about managing the symptoms, trying to maintain stability within these significant constraints?
Exactly. What would it truly take, going beyond just fiddling with interest rates or import rules, to build genuinely sustainable, broad-based economic growth in Nepal? Something to ponder.
It certainly underscores the complexity and the need for action on many fronts, far beyond just the central bank's toolkit.
Indeed. Well, that was a really fascinating deep dive into the intricate economic landscape of Nepal and the tightrope the National Bank is walking. Thank you for providing the sources that allowed us to explore this.
Yeah, hopefully this discussion gave you some valuable insights, maybe connected some dots for you about the challenges and perhaps the opportunities facing Nepal's economy.
And remember, if you have sources on a topic you'd like us to tackle in a future deep dive, please do send them our way.
Until the next deep dive.